Welcome to today's gold news overview. Today I'm going to be focusing mostly on events rather than gold price itself, but it's all related. I'm also going to be using a whole bunch of notes, articles, and research I've done, so forgive me if I accidentally mispronounce something while doing this. Also, I'm not doing much editing, so feel free to listen to this while doing something else. Let's get to it. China was the quiet headline today. Lending rates stayed unchanged. The 1-year loan prime rate is 3% and the 5-year is 3.5%. Keeping them steady signals caution while leaders meet this week to set broader policy priorities. For gold, steady matters because it avoids a surprise policy jolt and keeps attention on the yuan and everyday buying behavior. When the yuan weakens, the local gold price in renminbi rises and shoppers get more sensitive to weight. When the currency steadies, people hesitate less and dealers are more comfortable moving inventory. Over the next few days, the simple checklist is this: any policy messages from Beijing's meetings, the daily yuan fix, and whether retailers report healthy customer flow. If policy stays cautious and the currency is mostly calm, China continues to act as a steady absorber of metal rather than a source of volatility. India's festival demand is the main story today. After Dhanteras on October 18th, I hope I'm pronouncing that right by the way, after Dhanteras on October 18th, big city markets reported heavy foot traffic and late hours. The pattern is simple. People still want to buy gold during Diwali season, but they're keeping each purchase smaller. Coins, small bars, and lighter jewelry saw strong interest, while many households spill their budget, taking on small gold coin for tradition and putting the rest into silver or diamond pieces. Jewelers leaned on the usual tools for help: small denominations, clear pricing, lower making charge designs, and old gold for new exchange counters. The result is lots of transactions, even if the average ticket is smaller overall. That's exactly how festival demand adapts at high price levels. Shoppers trim weight, not the tradition. In the US, the key number this week is the delayed September inflation report. It was pushed back by the shutdown and is now due on Friday, October the 24th. That signal release can sway real yields and the dollar in one hit. So markets are basically marking time until it lands. Through the week, traders will lean on private surveys and headlines for clues, but the CPI print is the main event. The Fed won't pre-commit before that data. Officials are still talking about a data-dependent path, and the calendar has a handful of public appearances, but the line is familiar. Watch inflation, watch the labor market, and avoid promising a fixed rate path. With fewer official releases at hand, the tone around Friday's CPI and the same-day flash PMIs and consumer sentiment update will likely set the mood into the weekend. One more shutdown knock-on. Some weekly indicators have been patchy and claims for federal workers have jumped. That doesn't change the bigger picture by itself, but it adds a little noise to the usual read-through. The overall for gold watchers, the US story is about one driver this week, the CPI on Friday, because it plugs straight into real yields and the broader tone. Europe and the UK was steady but important today. The European Central Bank is still in watch the data mode, with big press conferences scheduled for the end of the month. That means no sudden policy shock this week, and markets will focus on incoming numbers instead of guesses about a pivot. A calm ECB tone helps cap how far European bonds can jump, which is quietly supportive for gold. In the UK, attention is on this week's inflation update. The September CPI report is due on Wednesday. That single release shapes the Bank of England's message, and it can move the pound. If inflation cools more than expected, it can ease rate pressure. If it's hot, it can keep the BOE cautious. Either way, the currency reaction feeds back into the global dollar story that gold trades against. Recent BOE commentary has also stressed that the UK's growth speed limit is lower than it used to be, thanks to long-running structural issues. For gold watchers, that matters because slower growth with sticky inflation risks tend to keep central banks careful and investors interested in hedges. None of this is a loud headline, but it sets the backdrop for how Europe and the UK will feed into the dollar, yields, and risk appetite over the next few days. So the checklist is simple. Watch Wednesday's UK CPI, keep an eye on the BOE remarks for any shift in tone, and note that the ECB's next formal update is due next week, not this one. Quiet policy, data in focus, and currencies doing the talking, that's the European story that matters for gold right now. Oil eased today on renewed US-China trade tension headlines. When oil drifts lower, it generally cools near-term inflation pressure because fuel and freight costs feed into many prices. That doesn't move gold by itself. However, it shapes the two levers that do: real yields and the US dollar. Softer energy can trim inflation expectations at the margin, which can steady or lower real yields. If the dollar also relaxes, gold usually breathes easier. If energy snaps higher on a shock, The chain can flip the other way. There's a bigger backdrop here. The International Energy Agency recently warned that supply could outpace demand into 2026 by a wide margin. Markets have been trading that theme for days. Oversupply talk often caps oil rallies unless a geopolitical hit knocks output offline. For gold watchers, the message is simple. A calm or softer energy complex reduces the chance of a sudden inflation scare, which lowers the odds of an abrupt jump in real yields. Natural gas tells a similar, quieter story. European benchmark prices have been subdued this month compared to last year. Lower gas costs help headline inflation in Europe, and that feeds into bond markets and currencies. Again, this is not a one-to-one rule for gold, but it sets the mood that gold trades against day to day. What to watch next? The oil headlines tied to US-China relations, any supply interruptions, and weekly gas price updates in Europe. If energy stays calm, it supports a steadier backdrop for gold. If energy spikes, expect a faster move in yields, the dollar, and safe haven hedging. There are two steady forces behind gold right now: central banks and ETFs. On the official side, India just confirmed its gold stash has crossed the $100 billion mark. Wow, a lot of gold for the first time. That jump is mostly valuation, however. But it also fits the global pattern we've seen for the last few years. Central banks like holding gold as a long-term diversifier and as insurance against currency and geopolitical shocks. Even when the monthly buying slows, the intent to hold or add remains strong, and that supports the market during shaky weeks. On the investment side, gold ETFs had a huge September. Global funds saw their biggest monthly inflow of the year, making the entire third quarter a record. Large vehicles like the SPDR gold shares added tons in a hurry, as investors looked for a simple way to get exposure without dealing with the storage. That kind of flow tightens supply at the margin and can turn dips into quick rebounds when other drivers like the dollar or real yields stop pushing against the price. Put together, the message is simple. Central banks are slow, patient buyers, and ETFs are the fast money that moves when headlines change. When both point the same way, official demand steady, investor demand rises, you get a strong backbone under the market. That doesn't mean gold goes up every day, obviously, but it means setbacks are met by buyers who have clear reasons to own the metal. Today's geopolitical signals were busy but not explosive. US-China friction stayed in the headlines. Beijing kept lending rates steady while leaders met this week, and two sides traded barbs. China accused the US of cyber attacks on a national research center, and trade tensions flared in the background. Those headlines fed into weaker oil prices today, which matters because calmer energy can cool inflation pressures at the margin and ease some stress on real yields and the dollar. In the South China Sea, there was a small step towards de-escalation. Reports say Manila and Beijing are exploring a Coast Guard arrangement to reduce run-ins at sea. It's not a done deal, and past efforts have wobbled, but anything that lowers the temperature helps market nerves. Around the Russia-Ukraine conflict, the pattern continued. Ukraine has been striking Russian energy assets with long-range drones, while Russia has kept up attacks on Ukrainian power infrastructure ahead of winter. That mix keeps a mild risk premium in the system, especially for energy, even on quieter days. One more US-Asia thread. Washington's pressure on buyers of Russian oil resurfaced, with tariff threats in the headlines. That kind of policy talk can shift trade routes and add uncertainty to energy flows, which again loops back into inflation and risk appetite. For gold watchers, the takeaway is straightforward. None of these stories alone set the trend today, but together they shape the mood that gold trades against overall. Oil, a touch softer, the dollar watching policy talk, and safe haven demand ticking up when tensions flare, even if it's briefly. Here's the simple checklist for the next few days. First, China. Leaders are meeting this week, and Beijing just kept lending rates steady. Watch for any policy messages or signals on the yuan while the meeting runs. If the currency stays calm and dealers say premiums are steady, that keeps the physical demand healthy in the background. Second, the UK. September inflation lands on Wednesday, UK morning. That number can move the pound. A cooler read usually takes pressure off UK rates, and a hotter one can keep the Bank of England cautious. Either way, the currency reaction feeds back into the global dollar tone the gold trades against. Third, the US. The delayed September CPI is now due on Friday US time, Saturday if you're in Australia. That one report can shift real yields and the dollar in a single hit. Until then, the market is running light on official data, so headlines can push sentiment around more than usual. So it's good to keep that in mind, but not financial advice, of course. Fourth, the global activity pulse. Flash PMIs for the US, Eurozone, and the UK arrive late week. Soft readings often nudge yields lower and support gold. Upside surprises can do the opposite. It's not magic, it's just a quick read on growth momentum. Finally, the routine but useful tickers. The weekly US jobless claims are normally out each Thursday and still shape the growth narrative, although shutdown disruptions have caused hiccups. Also, keep an eye on daily notes from bullion dealers in China and India. If premiums hold up after Diwali, that's a sign real buyers are there to absorb dips. That's the watch list. If this helped, please like and subscribe and ask any questions in the comments. I enjoy reading and answering your comments. Thank you very much for watching.